Tyler, Stuart, thank you so much for joining us here at SuperReturn International, the largest one ever. It's quite a gathering, 5,000 here. What's it feel like to be part of an industry that obviously wants to come together like this?
It's certainly some great energy in the room. I've enjoyed meeting a lot of people and look forward to meeting a lot of people over the next couple of days.
Tyler, you're having a good time so far at SuperReturn International?
It's been great. It's amazing what the private credit industry has become here. I think this is probably a pretty small gathering 5, 7, 10 years ago, but now thousands of people. Definition of private credit has evolved, but the audience and the the buyers of that have evolved as well.
Well, obviously that says something about the health of this industry, perhaps, and the interest in this industry. What are your general observations, if you like, in terms of the outlook for private credit in Europe specifically at the moment, perhaps in comparison to the US, seeing as we're in Berlin? Stuart, if I could start with you.
Look, I think the outlook remains reasonably good for the European specs. There are some changes and some transitions that are happening. We're seeing people reach for larger deals. The area of the market where we play, however, which is the traditional middle market, I think is one where we continue to see robust opportunities. Pricing continues to hold at good levels. Structures can continue to be reasonably conservative, and we think the outlook there is reasonably strong.
Do you see key differences, or do you think those two markets are becoming more similar, Tyler?
It's honestly, as the European market has matured, they've certainly converged. I think the North American market is probably where Europe would like to be, 5 years from now. APAC is probably a further, couple of steps behind that. But I think just given the maturation, how quickly the European market has kind of caught up, I think you're seeing more and more similarities in that. Good example of that is, more transactions are starting to look like a club environment, and more so in the upper part of the middle market in Europe. But the club dynamic has been present in North America for a long time, but certainly very similar these days.
Now, one thing I think you've been talking about is seeing an increasing overlap between the broadly syndicated loan and direct lending markets. What would you say is driving that, Stuart?
I think it's a few factors. So, firstly, we've seen periods where the broadly syndicated market just hasn't been. And people who've been able to raise capital in the private world, they can see an opportunity and they've been able to kind of deploy that capital into that market and effectively replace the traditional syndicated space when that support hasn't been there. I think that's an interesting place to play opportunistically. I also think it comes with challenges. You're not at that point only playing against other managers, you're playing against other markets. And of course, what you then see is the potential for erosion in terms. And today, I think the erosion in price. We're already starting to see the syndicated market come back, and there's been a significant amount of refinancing back into that market over the first few months of 2024, and I think that will continue to be the case. So it's really driven by opportunity and capital, and I think we're finding a rebalancing of those markets today.
You described their opportunities. What would you say are the opportunities, challenges, and implications, if you like, of the Megadeals being financed through those direct lending markets at the moment, Tyler?
Yeah, we say a lot at Barings, how you raise money dictates how you deploy it. And I think you've seen a real divergence in terms of market participants, how they've raised capital. You've seen the emergence of, the perpetual vehicles where they'll take all of the capital in on day one at time of commitment. And they're left with a meaningful cash drag until they deploy it. So that has created a little bit of a style shift in terms of, what GPs need to do to get that money to work as soon as possible once they close on it. And there are other managers that will just go and raise increasingly larger and larger funds, effectively playing out a land grab, as it were, in the market. And I think that is an exercise that is kind of, I'm going to take as much money as I can and figure it out. And certainly from an asset manager's perspective, it can be quite efficient to deploy into these fewer and larger transactions. From a profitability standpoint, it's the same deal size, the same deal team size, doing a $100 million deal as a $5 billion deal. So there's certainly some efficiencies of that from a business profile standpoint. But I think what's important for investors to understand is with that, it's not all apples and apples, right? You're taking on different types of risks in that transaction in order to execute in that kind of different type of market. So you're seeing docs look more and more like syndicated docs. You're seeing that illiquidity premium which is really the target of any allocator into private credit, is being compensated for an incremental total return for that illiquidity risk that they're taking on. And you're seeing that really get squeezed out, where there is negligible, if any, and in some cases pricing inside of where liquid markets would be. So I just think, certainly not to say that there are no good deals in that part of the market, but I think investors really need to be eyes wide open in terms of what types of risks that they're taking on and seeing their GPs and seeing their partners move into that part of the market.
Real specialist expertise and relationships more important than ever in that sort of environment, arguably.
I think absolutely. I mean, people talk about the illiquidity premium in private debt, but actually I'd flip it around and talk about the why do sponsors are they willing to pay that premium? And the answer is it's about partnership, it's about certainty of execution, and it's about the flexibility to help them grow their businesses. And so I think when we look at the traditional middle market lending space today, all of those things really factor into a sponsor who's buying a business with a view to go buy and build and grow that platform over a number of years. So we continue to see that partnership is key in that space, and we continue to see great value there because we can provide all of those things, the certainty of execution and the flexibility to execute their strategy.
So a very complex picture that we're looking at there, and I guess what are the extra macro pressures that are going to overlay on top of that? We're looking at two big elections in both the UK and the US this summer. How do you think that's going to impact going forward, and what other emerging challenges do you see coming in the next year ahead?
Yeah, I think one of the nuances of private credit is we're in no way having to solve for an index. So we're not having to force square pegs into round holes and take a bit of exposure to every transaction that comes through. We have the ability to kind of cherry pick industries that make sense, types of businesses that make sense in a hold to maturity structure. So one great example of that is healthcare. So in North America, we tend to avoid heavily reimbursed healthcare, and that's directly relevant to the elections conversation, is we can't underwrite stroke of the pen risk, where reimbursement rates can kind of disappear overnight. By contrast, in Europe, we quite like healthcare in certain parts of the market because that payer landscape has been far more stable decade after decade. So just one example of kind of how we can position ahead of that, but also would just connect it back to a more philosophical view of again, what's appropriate in an illiquid asset. We're not going to do stuff like commodity-based businesses. We're not going to do retail, restaurants, health clubs, anything with a consumer trend or fad risk to it. But specifically to kind of the macro concerns building in the background, we can structure portfolios by avoiding that altogether, not by going underweight.
I guess it's going back to those teams with expertise and perhaps geographical nuance too.
And certainly, and people talk about rates higher for longer as being a kind of potentially risk to the stability of private credit markets. The reality is the last couple of years have already been incredibly volatile and talented. Inflation, whether that's people, whether that's energy, whether that's just supply side stuff. All of our companies have had to kind of manage their way through that. Now, I'm pleased to say if we're picking winners in sectors, then we've seen those businesses be able to pass through those higher prices. But again, that's not an environment or way of operating these companies have been used to. I mean, for the previous decade before that, most companies were in an environment where actually prices were flat or indeed had to come down. So we've seen a significant amount of adjustment. So it's really about understanding all the nuts and bolts around the credit. What makes the P&L function, what makes the cash flows really function, and all of that really bottom-up analysis is what's going into our credits.
Because there's been great resilience shown already, if you like, hasn't there?
Oh, it's been phenomenal. If you think about the last few years and where our portfolios sit today, I'm really pleased about the job the team has done.
Well, I hope you continue to have a great time here at the conference. It's been really great to hear your thoughts. Thanks for joining me today, guys.
Thank you very much.